Hello, friends. Thank you for joining us today for our 11 o'clock webinar. It's January 26th. Somehow we've almost blown through the entire month of January. Congratulations. Hope everyone's staying warm out there. Here in Richmond, it's kind of chilly and cold, but I guess that's par for the course. It is winter after all. We are going to discuss a hot topic this whole month again today, because it is definitely something that people are asking us about. And so we're going to continue to drill down into the Employee Retention Credit, or the ERC, which is affects both 2020 and 2021 now. And we will focus on that and take your questions. We also will touch a little bit on FFCRA, EIDL, and then of course, if you have questions on any other topic, we'll attempt to answer that as best we can. If you could enter those questions into the Q&A feature on your screen and avoid the chat, that would be great. We appreciate that. And with me today is Angie Trapp, Tracy Clark, and Kevin Wilson, and Ms. Leslie Bruno. And with that, I'm gonna say hi to my friend Tracy. Hi, Tracy.
Hi, Leslie. How's it going?
It's good. It's you know, we're just day by day. How are you?
I'm doing pretty well. I'm not enjoying the cold. I'm not a cold weather girl. I much enjoy the warm weather. So I'm actually sitting here at my desk with a heated blanket on me because
Nice,
I can't stand the cold.
nice. I have a cat on my lap, keeping me just sort of also a heated blanket. But yeah, we'll get through this. We'll get through this together.
That's right. Spring is around the corner.
Yes, that's right. So tell us what you've been, I know you have been fielding a lot of questions from our clients about ERC, and so we've decided to continue this as a topic for our webinars now for probably 3 or 4 weeks in a row. But it's
Yeah.
kind of complicated, and I know you've been answering a lot of questions. So are we, is there anything new, or are we continuing to just decipher what happened with the legislation from December?
So there really isn't anything new. What really is the motivator here is really getting the news out. So a lot of people qualify for the ERC that just really aren't aware that they qualify for the ERC. So I'm going to go over the criteria that goes around ERC, and hopefully if our listeners haven't heard about it, that they will write into questions@dominionpayroll.com to get more information about it. And also, if they do know about it, to spread the word to other business owners that could be, potentially qualify for this, because it could be a business saving program for them. So I just want to make sure that people understand what exactly they could get with ERC. The first thing is, and I know I've said this several times over the past couple of weeks, but people who receive PPP first draws and second draws now will still be eligible for ERC. That's huge, because at the very beginning of all this, when all these programs were rolling out, it was like, well, you could have, you could defer your payroll taxes, you could get a PPP fund, you could participate in ERC, but you couldn't do all of them. You could only pick one. And then they started changing the rules, and they said, well, you could have the payroll tax deferral and the PPP, but they never said that you could have ERC. That was just off the table. But as of December 27th, 2020, they went back and said, okay, well, we're going to make it retro, and that recipients of PPP funds can use ERC. The only catch in all of that, and it makes sense, is that you can't use the ERC and PPP loan funds for the same wages. So that was their one thing that they put out there. So I'm going to talk about Retro 2020 ERC. Now, this program was available from 3/12/2020 through 12/31/2020. And in general, this is how it worked. If you were a business that employed under 100 full-time employees, you could claim a credit of up to 50% on those employees' qualified wages that were paid from March 13th, 2020 through December 31st. Now, that the, the wages could be earned between March 13th through December 31st, but you actually had to be qualified to participate in this ERC at that time. So if you weren't closed down, or you didn't qualify as of March 13th, but you were closed down, let's say on March 17th, then the program would start on March 17th. So that's kind of how this works. And I'll talk a little bit more about that in a minute. Also, for the purposes of this credit, wages can include the employer portion of group healthcare costs, and that's all the pre-tax stuff. So it's the same healthcare costs that can be included in the FFCRA wages. They can also be included here. All right, so the maximum eligible wages per employee is $10,000. And that results in a maximum annual credit of up to $5,000 per employee. So it's up to 10,000 of eligible wages, and you're going to get back 50%. So that's where the 5,000 comes in. To qualify for the credit, an employer must meet all of the following criteria. The employer must have carried on a trade or business during the calendar year of 2020. So this includes brand new businesses, so that you didn't have to be in a lot of the other things. You had to be in business in 19, but for this one you did not. And the operation of that trade or business is either fully or partially suspended due to orders from an appropriate governmental authority limiting commerce, travel, or group meetings due to COVID-19, or has gross receipts for at least one calendar quarter in 2020 that are less than 50% of the gross receipts received during the same calendar quarters in 2019. So that period of significant decline in gross receipts is recognized until the end of the 2020 calendar quarter, in which gross receipts are greater than 80% of gross receipts in the corresponding calendar quarter in 2019. And that's actually carried over into 2021. I'm going to talk about that in a little bit too. So that's how the gross receipts works. For if you've been shut down or partially shut down, it only goes, you're only qualified for the period that you have that full or partial shutdown. Now, if you're a restaurant or you're a gym, you're still not at 100% capacity. So you're still qualifying under that first criteria of the fully or partially shut down. I also wanted to expand upon that. You can be kind of grandfathered into that criteria if you are a business that was impacted by other businesses that had to be fully or partially shut down. Let me give you a couple examples. So let's say you're a restaurant supplier. Maybe you supply, fresh vegetables, and you were considered to be an essential business like a grocery store. So you were allowed to be open. So you didn't have a governmental mandate telling you that you had to be shut down. However, all of the businesses that you supply were told to shut down. In that case, you also qualify under this fully or partially suspended. Another situation, let's say you're a manufacturer of, some kind of, let's say you were manufacturing some kind of PPE, or you're manufacturing something that was considered to be essential, and you weren't mandated to be shut down. However, the company that supplies you with your raw materials was required to shut down. You would also qualify under the fully or partially suspended due to the orders, because you can't carry on your business due to the shutdown of an essential component of what you were doing. So that's how other businesses can be kind of looped into that fully or partially suspended portion. Okay, so if you were an employer of under 100 full-time employees, all wages are eligible for this credit. But if you're an employer with over 100 full-time employees, ERC is only available on wages and healthcare paid to or on the behalf of employees not working. So that was if that's above 100, it's one bucket, and if it's below 100, it's a different bucket of wages. So that 100 employee threshold is based on the average number of employees during 2019. So that is the retro ERC. Now, if you think that you qualify for this, please send in a request for information, or if you want to talk to me about that, I'm happy to do that. If you just want some more information on it, send in an email to questions@dominionpayroll.com and we'll get back to you. Okay. ERC in 2021 is a completely different situation. So in this one, the bill is going to extend the availability of ERC to qualified wages paid through June 30th of 2021. And the program got enhanced in a couple of ways. So this is going to cover first quarter and second quarter. Reduced the quarter over quarter gross receipts decline from 50% to 20%. So you're comparing your 2021 calendar quarter to the corresponding quarter. Sorry. You can tell I'm working at home and someone just rang my doorbell. So
you got a package.
Yeah, probably.
It happens to us all.
Can you take over while I get the hounds calmed down?
Yeah, sure. So the first bullet here, like she said, is changing in 2021 is that quarter over quarter gross receipts decline is going from 50% to 20%, and you're comparing the quarter to the corresponding quarter in 2019, because we're assuming that your 2020 quarters would not be worth comparing to. The second enhancement is that it's increasing the wage limit to $10,000 per employee per quarter rather than $10,000 per year as it states in 2020. It also increases the ERC percentage from 50% to 70% of gross wages. Increases the quote large employer full-time employee limit from 100 to 500. So that's a big difference, and that'll affect a lot of you there. And then new employers who were not in existence for all or part of 2019 can use the comparable 2020 calendar quarter to determine the extent of the decline, excuse me, in gross receipts. So
hey, I'm back. Oh. Thank you.
Excellent. No, I was just reading through that last bullet, which I'll read again. New employers who were not in existence for all or part of 2019 can use the comparable 2020 calendar quarter to determine the extent of the decline in gross receipts. So that's one exception to that look back period. And Tracy, does it matter when they started? If they founded their business in 2020, does it matter? I mean, I'm assuming it was probably earlier in the year than later. Does it matter?
It doesn't matter unless it does, I guess. If you came into existence, in the third and fourth quarter of 2020, then you don't have a comparable period because we haven't gotten to those quarters, obviously. So for those businesses that came into existence much later during the year, they would have to qualify under the fully or partially shut down because they don't have a decline in receipts to be able to show that.
Right. Okay, just wanted to clarify that.
But this is huge because 70% of gross wages per quarter, that could be up to $14,000 per employee. And just depending on how many employees you have, it's just huge. So again, if you think you qualify for this, or you want more information, you want to talk about it, I would reach out to your CPA as well, because they're going to be the ones that are going to help you with that gross receipts decline. But also, I did talk to a couple of CPAs this week that just, there's so much going on, and they didn't realize that ERC was available along with PPP. So sometimes it takes a little education on people. So just keep kind of pushing your CPA, or and rely on us. We have some information. I'm not saying I'm an expert. I'm just saying that I read a lot, and I'll do my very best to analyze your situation and help you qualify for this if you do, and then help you get it set up within our system so that you can get back some much needed cash flow. But at any rate, yeah,
Tracy, there's a question that I think we could knock out right now.
Okay.
I'm sorry to interrupt you, but Jonathan asks, does the 100 full-time employee criteria apply to individual employer IDs or entities, or is it controlled groups?
If you have those different employer ID numbers, I think you can, just like you would for a PPP fund, if you can get separate PPP loans, then you can get separate ERC credits.
Okay. And
So
so
that's my understanding.
if you're not a Dominion payroll client, then you want to talk to your payroll provider
Mhm.
to
Or your CPA could help with this. I mean, they're going to have to file those amended 941s for the retroactive. So, you know, your CPA could help you with that as well. But we're happy to do that as, you know, if you're a client of ours, and hopefully you are a client of ours. All right, so that is kind of those two. I did have a couple of things that I wanted to point out just because I've been fielding a lot of questions and some things that have come up a bunch of times. I just wanted to put on this page. That 49 and 20, those are from the FAQs from the IRS. So one of them was like, you know, how do you figure out what a full-time employee is? Because as you know, if you're trying to figure out like FTEs, or you're trying to figure out what a full-time employee is, there's all these different rules out there. But this actually comes from the ERC FAQ. So their idea of a full-time employee is somebody who worked 30 hours per week, or if they have, you know, crazy kind of schedules, it's 130 hours of service in a month. So that's kind of how you figure it out. The other thing is that all the wages that you paid, even if you have part-time people, they would all be eligible for this. So it's not just for the people who are full-time. And then are tax exempt employers eligible for the employee retention credit? So yes, so organizations described in section 501C of the Internal Revenue Code and exempt from tax under the section 501A of the code may be eligible employers for purposes of the employee retention credit if they are the employers that otherwise meet the requirements to be eligible. So yes, so the tax exempt people are. And then the qualifying health expenses include not only major medical coverage, but also dental and vision and any other benefit to which COBRA continuation rules would apply. So those are just some things that I wanted to clarify on that I just get a lot of questions about. Okay, just a little blurb on EIDL. You used to have to put down, and I believe it's still on the application, but you used to have to put down how much you got in EIDL advance, and then they were going to deduct that from your PPP forgiveness. And they're not doing that anymore. So your EIDL is actually a grant, and then the PPP fund is separate from that. And to be fair, I'm almost 100% positive that when EIDL first came out and Kevin was talking about this, he said that you wouldn't have to pay back EIDL and that it wasn't included in your PPP fund. And then we got clarification that it was, but now look, Kevin, you're right. Now you don't have to pay back EIDL and you don't have to deduct it from your PPP. So
it is a rare day when I get to say I am right.
I hate it when he's right.
In
The
this case,
worst.
I'm happy for it.
Yeah, for sure.
I had the long money on EIDL being free money.
We'll
Man,
never
that
hear
was
the
like,
end of this.
how long was that? You had to wait like 8 months for that to happen.
Yeah.
But there you go. So I'm super happy about that. FCRA extension. Leslie, do you want to hit this up? Or do you want me to read it? I don't care.
No, I got it.
Okay.
I live for FFCRA. When actually it's funny. It's not funny, but it's interesting to me that Congress didn't extend the mandatory piece of these into 2021 because, man, I mean, I'll tell you, the last 2 weeks, I've had a ton of clients call with questions about this because COVID cases continue to disrupt their business. And they're, you know, and now it's even more complicated because it's discretionary. So I will explain what all of that means on this slide. But essentially, if you had a employee, well, let me start with a quick note about 2020. So in 2020, it was mandatory. Your employees were legally entitled to this leave if they qualified for it. If you have somebody who took leave in 2020 and you didn't pay them under FFCRA, they have 2 years to file a claim against you to get to realize those wages. So, or if you did pay them, but just under regular compensation, and you'd like to go ahead and pay them with the tax credits, we can work that out for you. But I just wanted to note that the DOL is saying that if you have an employee who thinks that they qualified for wages and didn't get them in 2020, then they can actually say, hey, wait a minute, I'm entitled to these, and they might have a case. So just want to put that out there. But going forward in 2021, these tax credits are still available for these wages, but it's now up to you, the employer, to decide whether or not you will grant them. So all the other qualifiers apply. It still applies to companies with fewer than 500 employees, still applies to full-time, part-time, and seasonal employees. If they get sick, have symptoms, are awaiting a test, or waiting out symptoms, or caring for someone who is sick, or home with children whose school or place of care is closed due to COVID. So all of those qualifiers are still the same. The maximum per day is still the same, $511 per day for that emergency paid sick leave portion, $200 a day for expanded FMLA. So all that's the same. Now I will say too, a quick note, if an employee has taken these leaves already in 2020 and exhausted them, then they cannot take them in 2021, unfortunately. But if they only took part of it, then they are able to take the rest of it if they need it. But again, if you're willing to grant it. So just a quick review, emergency paid sick leave is up to 80 hours, or what they would normally work over a 2-week period. So if they work 40 hours a week, then they are entitled up to 80 hours. But if they have a variable schedule or part-time schedule, then it would be what they would typically work on average over the course of 2 weeks. So say they took, they needed to take a week's equivalent of a week's worth of hours in 2020 because they thought they had COVID and they sought a test. And so you paid them on FFCRA wages in 2020. Technically, they'd still be entitled to another week's worth of wages in 2021 if they get sick again. And let me tell you, people are definitely still getting sick. So it's something to consider. I know it's discretionary now, but you're not paying these wages, the government is, and it's still a great way to keep sick people out of your workspace and from spreading the virus to your other employees and risking taking down more of your staff. So I think it's a really great option. Excuse me. People still have to qualify for it, though. You need to shake loose a little bit of documentation from them if you can, around their best efforts to get a diagnosis or seek treatment or monitor their symptoms accordingly. And then, of course, if their place of childcare is closed, that's also something that you could easily document. The expanded FMLA, just a quick reminder there that that's only available for the childcare reason, and that is up to 12 weeks. So if somebody took part of those weeks in 2020, that you could still give them the remainder in 2021. And that's paid at 2/3 their regular rate of pay. But again, you're not paying those wages, somebody else is, and that is the government. So, so definitely something to consider. Schools out there are still closed. So if somebody has a request and needs to take some paid leave, we have a request form on our website that you can use. It's a really handy way to document that request, keep that in their file. And then you would work with us as your payroll provider, or if you're not our client, you work with your payroll provider to code those wages appropriately so that the credits that the payroll taxes will be deferred back to you and not to the IRS. The voluntary portion of this is as of now it extends through March 31st of this year. We'll see what Biden does in terms of extending paid leave. It's definitely on his list of things to look at. So we'll see how if that date moves. And again, if somebody has a balance of FFCRA hours from 2020, they can use that in 2021. I will also say,
Okay, Leslie just got disconnected. So
all right, I'm back.
she's back.
Sorry, gosh, what a weird
This
day.
is a day.
Yeah, I don't know what's happening. My power went on and off real quickly. So in any case, sorry about that, guys.
Hmm.
I think I've pretty much wrapped up FFCRA, so
Okay.
hopefully that we got it all out.
Well, they can always send in a question to questions@dominionpayroll.com if they have any questions on that. So we're good. Thank you, Leslie. All right. Last but not least, PPP first and second draw updates. There was a new forgiveness application that was released for loans under 150K that came out on the 19th of January. I haven't seen it at the lender's portal. I don't really think that the lenders are going to change their portal too much to reflect this 150K, but they may. It is pretty similar to the one that's for loans under 50,000. Clarification was released for PPP second draw businesses not in operation on February 15th, 2020 shall not be eligible for a loan. So the reason was that new businesses were unable to demonstrate revenue loss. So even though they may have been able to get a PPP loan for the first round, they're not able to get it in the second round. I just saw that had come out. You want to understand the new expenditures that are eligible for forgiveness. There's new guidance that makes certain covered operation expenditures, covered property damage costs, covered supplier costs, and covered worker protection expenditures are eligible for PPP forgiveness, and they're applicable to past and future loans. So unless your loan, unless your loan has already been forgiven, you can't go back and make adjustments. But if you haven't done your forgiveness and you want to include those expenses, you certainly can. So those are all the updates I have on first and second draw. If you are a Dominion payroll client and you are looking for documentation for that second draw, you will use the CARES Paycheck Protection Program report. And I've been over that report pretty thoroughly. I've looked at it with several clients, and it looks pretty good. So your average monthly cost should be reflective of everything that's allowed to be in there for payroll. And that's about it on that. So we are through with all the content for today.
And we don't have any other questions in the queue.
Okay.
So I just want to go over Thursday's webinar is going to be an overview of the system. We're going to dig into the functionality, show some tricks, and just basically, I call it a high level overview. And this is great for both clients and prospects. It shows you items if you're a client that you might not have turned on, or you do have turned on but not sure how to use it. And some of the items that I do show the function's not turned on for you, but there's no additional cost for it. So some of it's vamping your employee self-service or your HR cabinet. And again, it could be turned on and you're not using it. And then for prospects, it just gives you a quick opportunity just to take a look at what we have. And here come questions. Can you repeat the email address for questions? Thanks. It's questions dominionpayroll.com.
It's right there.
And then to clarify, if we qualify for ERC, we should ask for guidance from both Dominion and our CPA.
Well, your CPA is going to be able to speak to your decline in gross receipts. And if you're, if you're well versed in that, that's not a problem. Or if you already know, hey, I qualify under the fully or partially shut down. So I already am, I already know I qualify. You may not need your CPA. I'm just saying that, if you want to be sure, reach out to them. They may have more information, and we can certainly give you some information, or we can talk with you about it. I just want to make sure that you understand the criteria that qualifies you to receive this credit. I don't want there to be any mistakes. That's my whole point.
Because Tracy, we can't, or maybe we can, maybe you can clarify, is to the extent that we can actually determine whether or not they qualify. I mean, is that something that they need to come to us with already decided?
Yes, we can't determine if they qualify. So that's really on them. What we can do is help them determine what the credit is. We will, we'll run a report and figure out what their credit is, and we can apply the credits, and we can file the amended 941s for 2020, and we can file the 941s, reflecting the credit in 2021. But what we can't do is determine if they actually are eligible.
Okay, that's helpful. And then what's the timeline? Is there, like, if somebody determines tomorrow and they have it all worked out with their CPA or their internal finance department that they qualify, and they come to us and say, hey, we want to go ahead and get the ball rolling, what does the timing of that look like?
So right now we are working on a statement of work, which should be out this week. We're going to be sending that out ASAP. I'm working on that this afternoon to make sure that we've dotted all the I's and crossed all the T's. And then once we get information back from clients, we're hoping to get this rolling next week. We're hoping to get started with the 2021 credits going forward, and then also working on the retro, and also catching people up, because some people already qualified as of January 1st, and we're going to need to get them caught up, because January's over just about.
Right.
We will get everything covered. It's just, we're just working on our timing right now.
Okay. And so this is another silly question, but so for first quarter, so they wouldn't actually receive the money until end of first quarter earliest?
Well, it's kind of, that's a yes and no question. It depends on what they want to do. There is a form 7200 that you can fill out. Let's say you processed all these payrolls for January, and you looked, maybe you have a lot of employees, and you have a lot of money in there, so that's showing up as a credit way above your tax liability. Because once it goes above your tax liability, it basically becomes a refund. And so let's say you have, $100,000 in credits that you're never going to use. You can fill out a 7200 and get your money back sooner than the end of the quarter. And it's a kind of a misnomer. You're not going to get that money back as of the end of the quarter, because it's got to go, the 941 and even the 7200 is going to go to the IRS. They got to process that, and then they'll, issue a refund check. So it's not a super fast turnaround. Well, I don't know if it's not I'm going on the fact that it's the government, and it's not going to be a super fast turnaround.
Right. That's fair. Yeah, I just had some blind spots around sort of the process of how this works, because I'm sure they're going to get inundated with forms and applications, and so we don't know exactly, we can't control that, but we're assuming that hopefully they're staffing up and getting ready for this.
I certainly hope so. I feel bad for them. I mean, just a little bit, maybe not a lot, but I do feel bad. Maybe I feel bad for the people that are relying on them to get this money back out to them, because I just think that by opening the floodgates of going with retro, oh my goodness, all the amended 941s that are going to be coming in, it's going to be crazy.
Yep.
We do have another question out in the queue. It says, does a quarter under ERC need to be a traditional January through March, or can it be February through April?
It has to be traditional.
Thank you. So that is all the questions. Kevin or Leslie, do you guys want to talk about tomorrow's webinar?
I would be happy to. Thanks. So tomorrow we're hosting the Beacon, focusing on outdoor tourism and the impact it has on the local economy. Got some great guests lined up. Rita McElhenney is the CEO of Virginia Tourism Corporation. She'll be joining us alongside Rod Kessler, the GM of Wintergreen Resort. And just booked today, we have Penelope Davenport, the program manager for the James River Park System, joining to discuss the impact that all this time that we're spending outside has had on local economy and sort of what that looks like going forward. So I think it should be a really interesting, wide-ranging conversation, and I do hope that everybody will join us tomorrow at 11.
And we have, Kevin, do you know about the webinar this afternoon at 1 o'clock?
That is with Dennis Tender, right?
Yes, it's it says the F word, understanding you for your fiduciary as a 401k plan sponsor. I didn't know if you had any details on that.
So this should be a really interesting conversation. Our own Dennis Tender with DP Grow is hosting that. You may recall that towards the end of the Obama administration, there were requirements that were about to go into place for financial advisors to have they were required to be what is known as a fiduciary, which means that they have to advise you according to your best interests, rather than they can't have personal interest in the advice that they give. So it's a something that fell out of the limelight during the Trump administration. There's a likelihood that the Biden administration may bring it back. But yeah, Dennis will be able to speak to that, and his knowledge around all things 401k and these roles and responsibilities is second to none. So check him out at 1 p.m. today.
Yeah, and he's such a great resource. He explains things in such a way that it's really in layman's terms. If you have any gray areas around that part of finance, he's just, I know I ask him a lot of questions all the time, and he's always very, very good at answering them. So I'll be definitely tuning in.
Well, thanks, you guys. There are no more questions in the queue. Again, if the questions come in after we get off the webinar, just send them to questions@dominionpayroll.com. Thanks, everybody. Have a great day.
Have a great day.
Take care, y'all.